Over to you, Mark. Did I get myself?
Good morning, everyone. This is Millie Hong, Head of Events at ASIFMA. Thank you for joining us at this virtual event, Singapore IBOR Transition. Let me introduce our host today, Mr. Philip Dirks, Managing Director, Head of Fixed Income at ASIFMA. Philip, over to you, please.
Thank you very much, Millie, and very happy and delighted to be here today, and clearly sharing that we are over close to 1,000 registrants today, so it's almost full house, and so it's great. Very happy to see that going. And first of all, I before we start, I really would like to thank the MAS who will honor us of their presence, the Association of Banks of Singapore for partnering with us and co-hosting this event, and our lead sponsor Refinitiv, and our gold sponsor EY. So thank you very much for that. As you probably know, ASIFMA is an independent regional trade organization. We have close to 150 members, banks, brokers, asset managers, consulting firms, law firms, and market infrastructure service providers. We are the voice of our members as we promote and advocate for a liquid, deep, broad, and capital market infrastructure, capital market, also a stable, competitive, and efficient one. We've also developed an education role, and we have recently started a series of training on several topics relevant to the capital market in the region and designed for junior staff and newcomers in the industry. So I encourage you to visit our website if you want to learn more. And it is in that educational role that we have envisaged to support our members and the broader market on the critical LIBOR transition. And there was a strong willingness indeed from our members to see ASIFMA playing a role in the IBOR transition. This is indeed one of the most significant transitions the industry will have to go through, pretty similar in impact to the migration from MT to ISO 20022 in the payment space. Our colleagues from ISDA, ICMA, and IPLMA are currently working very hard on the documentation and contract obligations linked to these transitions. But we found that in the region, there was quite a lack of awareness and a strong appetite from our members to understand what it meant for them, for the industry, and for their firm. So we decided to organize webinars, and we thought initially that we could concentrate on two main centers, Hong Kong and Singapore. And we quickly realized when we organized the first one in Hong Kong with the HKMA, that the other jurisdiction did not join, and they were really looking for local content. So we have embarked in rolling out sessions in several jurisdictions in the region. So we've done Hong Kong, Malaysia, India, Vietnam, Thailand, and Indonesia. We have Singapore today, and we'll have Taiwan after Chinese New Year, and hoping to roll out Philippines and China at the later stage. So it has been very successful so far. We have here in Singapore, I said 888 participants. Isn't that a lucky number to start? And in the past, over 2,500 attendees across the previous sessions. And that was certainly facilitated by the support we had from the central banks in the various countries and jurisdictions, but also the local market and banking associations. From discussion with our members, we also realized that there were a number of frictions and issues still outstanding, and probably more by the day. So we decided to capture these issues through a survey. And one of our law firm members, Ashurst, has consolidated the results into a paper that will serve as a base for a future action and advocacy. The paper is also available on our website for consultation if you're interested. And I'm sure, honestly, that the key findings of the survey will be covered by our speakers and panelists today. We've also published last summer with ICMA, ISDA, and APLMA, with the contribution of Deloitte and Morgan Lewis, an IBOR transition guide for Asia, And the paper that lists basically the key implementation issues and provide a practical implementation checklist for financial institutions as they are moving to implementing their individual transition plans. And it's also available on our website. So the Financial Stability Board has just published, it was late November, the latest LIBOR transition report, in which they recognize the work that has been done so far in the major jurisdictions around the world, but they also share recommendation and stress the work still ahead of us. And although IBA recent consultation might end up giving some respite to some US denominated contracts maturing beyond the 31st of December 2021, the industry should not lose sight of the task ahead. So this webinar is certainly very, very timely, and we have definitely a very packed agenda. And for the sake of time, I will not go through the agenda. You have it in your pack and in your invitations. Before we start, some housekeeping rules. At the request of our hosts, these events will take place under the Chatham House rules. So beforehand, we thank our friends from the press for their understanding. If you have questions, you can log them in the chat functions, in the Q&A section you have at the back, at the bottom of your screen, and we'll try to answer them as much as possible at the end of the event. As the session is full, so we had to push back on some of late registration. The session will be recorded and will be available online for any of you or your colleague who wish to see it again or have not been able to attend. So without further ado, I'm very pleased to welcome Ms. Ong Ai Boon, who is Director of the Association of Banks of Singapore, our partner and co-host today, to deliver her welcoming remarks. Ms. Ong, over to you.
Thank you. Can you hear me now? Sorry. Yes.
Very well, very well. We hear you and we see you.
Thank you, Philip. Well, it's wonderful to be partnering with ASIFMA, and this is not the first time you have done it, and you are doing it again. So we're very pleased to co-host this event this morning, and especially this partnership is very meaningful and beneficial, especially for topics like this that span across borders and product types. So we are very pleased that today several of the ABS and the MAS steering committee for the SOR and SORA transition will be speaking to each of you, and I just want to take this opportunity to say wish you a very fruitful session. So thank you very much.
Thank you very much, Ms. Ong, for your kind words. And indeed, I really hope that, and I'm sure we'll have a very fruitful session. Indeed, close to 950 participants, so we're getting close to the thousands. I would like to welcome. I'm very pleased to welcome Mr. Leong Si Chong from the MAS. He's a Deputy Managing Director of Markets and Development on the Monetary Authorities of Singapore. So, Mr. Leong, thank you very much again for joining us. The floor is yours.
Thank you, Philippe. Good morning, everyone. First, let me take this opportunity to wish everyone a Happy New Year. Let me also thank ASIFMA and ABS for organizing this webinar and inviting me to speak on the important issue of Singapore's interest rate benchmark transition. So in the next 20 minutes or so, I will do a brief recap of the key objectives and the milestones that we had set out last year. I will then touch on some recent developments in the US and UK that have a bearing on our transition timelines. And I'll finally outline what our priorities are for this year in the transition to SORA. So back in 2019, the financial industry in Singapore, represented by the ABS and the Singapore Foreign Exchange Markets Committee, assessed that given the eventual discontinuation of US dollar LIBOR and SOR, the most sustainable and sensible path was to transition affected SOR markets to SORA. SORA is a robust interest rate benchmark underpinned by transactions in a deep and liquid overnight interbank funding market. Such a shift would be aligned to the global direction seen in other major financial centers and support continued active participation of global institutions and investors in Sing dollar markets. Now, this transition effort was always going to be a complex task, and a strong public-private partnership was needed to address wide-ranging implications across multiple industry stakeholders in order to achieve a smooth transition. To this end, MAS established an industry-led steering committee, or SESTS, to provide strategic direction to develop new products and markets based on SORA and oversee the effective transition from SOR to SORA. Since then, we have made significant strides in developing SORA markets, even while tackling the challenges and disruptions from the ongoing pandemic. In the derivatives space, new market templates were developed to support the trading of SORA derivatives. LCH started the central clearing of SORA derivatives early last year up to the 5-year tenor, while key dealer banks started making markets in SORA derivatives. MAS also launched a daily SORA derivative auction to facilitate price discovery and to develop SORA OIS and SORA basis curves with prices quoted by dealers and brokers to key market data platforms. Trading volumes in SORA derivatives have continued to rise, doubling in the last quarter, albeit from a low base. In the cash market, adoption of SORA has broadened significantly. We have seen several sizable SORA-based commercial loans involving early pathfinders such as CapitaLand, Olam, Wilmar, and Sembcorp Industries. Our local banks have also launched several business and retail SORA property loan product offerings. Given the strong interest in SORA products and progress made in kickstarting SORA market liquidity, the Industry Steering Committee also announced that usage of SOR in new cash products will cease by April 2021. To support this, our key retail banks will lead the way by offering a broad suite of SORA products by end February 2021. Other banks active in Sing dollar retail and corporate loans will follow suit by April 2021. Another significant development last year was the industry decision to discontinue IBOR by end 2024 to reap the expected benefits of enhanced market efficiency in a SORA-centered interest rate benchmark regime. So let me now touch on what many of you in the audience would consider the elephant in the room. In December 2020, the IBA, or ICE Benchmark Administration, consulted on the LIBOR discontinuation timelines across the various currency settings. What caught most of our attention was the proposed 18-month extension till 30th June 2023 of the widely referenced US dollar LIBOR tenors, overnight 1 month, 3 months, 6 months, and 12 months. The overarching policy intent of the extended end date has been made clear in the commentaries from authorities in the US and UK. The proposed extension will allow more time for the transition of legacy contracts, while the usage of LIBOR in new contracts is to cease as soon as possible. So US regulatory authorities have stated that the use of US dollar LIBOR in new contracts after 31st December 2021 would create safety and soundness risks. And this should cease as soon as practicable and latest by end 2021. In the UK, the Financial Conduct Authority will be consulting on an approach to prohibit some or all new use of LIBOR after end 2021. This would likely be coordinated with similar measures across other key jurisdictions. All these suggest that after end 2021, new cash and derivative contracts in these currencies will predominantly reference overnight near risk-free rates, while LIBOR markets will decline in liquidity. So what does this mean for our Sing dollar benchmark transition efforts? So the SESTS has reviewed its key priorities and timelines against these developments and will be publishing later today an updated transition roadmap for 2021 and 2022. While we recognize that there could be further changes pending the finalization of IBA's proposal, there was broad consensus within the committee that we should keep building on the strong momentum generated over the past year. Let me share with you 4 key takeaways of the SESTS arising from these latest developments. First, the proposed extension of LIBOR discontinuation means that SAW will end when LIBOR ends in mid-2023. This has 2 benefits. One, it will allow about 70% of existing stock of legacy SAW cash products, or about $65 billion of bilateral and syndicated loans, to mature before the new deadline. This is a good development as financial institutions will have a smaller stock of legacy transactions to manage. 2, the extension provides time to do more to actively transition legacy SAW contracts to SORA and to deal with the most challenging legacy transition issues. We seek to complete this transition as an industry by no later than end 2022. Second, it must still be the case that we stop adding to legacy SAW exposures as soon as practicable. Hence, there was unanimous support within the Industry Steering Committee to cease the use of SAW in new cash products by April 2021, as originally announced. In addition, the committee is considering the need to set a clear timeline, possibly sometime in second half 2021, to cease the use of SAW in new derivative transactions, except where strictly necessary for risk management and for unwinding of legacy SAW exposures. This timeline will support a more coordinated shift to SORA among key derivative market participants. This will also align our market with similar timelines being contemplated for stopping new LIBOR transactions in other key jurisdictions. The SESTS expects to share its guidance in the coming months after incorporating feedback from market participants. Related to this, the committee had previously announced in December 2020 that it plans to set out guidance on timelines to cease the use of SIBOR in new loan contracts in 2021. This will likewise be finalized in the coming months. So taken together, we expect SAW, SIBOR, and LIBOR activities to wind down towards the end of this year. This in turn will generate a growing critical mass in new SORA-based cash market activity and spur greater market efficiency and liquidity. Third, the committee and MES will take further steps to develop a robust SORA curve to reinforce the shift to a SORA-centered regime. We will do so by undertaking several initiatives in the first half of 2021. To establish a robust SORA curve, the Industry Steering Committee is coordinating closely with LCH to extend central clearing for SORA derivatives from 5 years currently to 21 years in the coming months. This will mitigate counterparty credit risks and support higher SORA transaction volumes and market activity across the longer tenors. Similarly, MES will also extend the tenors and broaden industry participation in our SORA price discovery auctions. Since its launch in June last year, the number of participants in the auctions has doubled from 6 to 12 major banks. This has facilitated price discovery in SORA derivatives up to the 5-year tenor. Given the positive outcome, MES will extend the tenors of SORA auctions to 20 years from 1st March 2021. We expect the bid-ask spreads for SORA OIS and SORA basis swaps at the longer end of the curve to tighten further with these enhancements. To further enhance market depth, MES will expand our SORA floating rate notes program. This was launched in August last year and has met with strong investor demand, with outstanding size growing to 5.3 billion Sing dollars in only 6 months. Looking ahead, we will extend the tenors from 6 months to 1 and 2 years in the first half of this year. The 1-year tenor will be issued quarterly, while the 2-year tenor will be issued semi-annually. We will also gradually increase the issuance sizes if investor demand continues to be strong. Fourth, notwithstanding the possible discontinuation of SAW in mid-2023, we strongly encourage active transition from SAW to SORA during the second half of this year. This is a specific window where we expect both SAW and SORA markets to continue to be liquid, and transition from SAW to SORA will be the most conducive for market participants. There are 2 key aspects. On derivatives, key banks remain committed to wind down the bulk of their SAW exposures by end of Q3 this year, as announced by the SCSTS last October. This will involve active participation in vendor-provided compression and conversion services to reduce SAW exposures at an industry level. Broadly speaking, the compression exercises facilitate the multilateral netting or reduction of gross SAW derivative exposures, while conversion cycles provide a multilateral mechanism for counterparties to convert their SAW derivatives to a SORA reference. This is already in progress. The first Sing dollar compression cycle for this year will be held this week. SCSTS plans to publish an advanced calendar of relevant SAW compression and conversion cycles in 2021, offered by various vendors. The steering committee strongly urges all SAW derivative participants to utilize these cycles. Having a critical mass of industry participants will enhance the multilateral netting effects and put the industry in a stronger position to meet its wind down targets. For loan markets, the Industry Steering Committee will publish by April 2021 market guidance on the transition of bilateral corporate and retail loans, and set out further guidance on market mechanisms for converting legacy syndicated and hedge loans by the third quarter of this year. This is expected to rely on active SAW to SORA transition in the derivatives market to establish relevant pricing references for the transition of syndicated and hedge loans, where coordination across borrowers and lenders is essential. But the key message is this: banks should actively engage their corporate customers to proactively undertake legacy transition wherever possible by end 2021. While some customers may be inclined to adopt a wait-and-see approach, particularly since LIBOR and SAW discontinuation could be extended to mid-2023, it is important to bear in mind that SAW derivatives liquidity will start to decline in 2021. There are 2 reasons for this. Liquidity in derivatives will start shifting to SORA, particularly from April onwards, given the stop to new SAW cash products. And as all hedges on new cash products shift to SORA. Likewise, with the Industry Steering Committee considering a cessation timeline for new SAW derivatives, likely before end 2021, market participants should expect SAW liquidity to decline further, as key banks will not be able to undertake new SORA derivatives transactions. Now, it is hard to say for certain when SORA liquidity will exceed SAW liquidity. But based on our planning parameters, it is likely that the sweet spot for active transition could be between mid-2021 to early part of 2022, when SORA markets would have deepened sufficiently while SAW derivative liquidity still exists, before declining subsequently. This period of trading will provide the most robust SAW to SORA pricing references for transition of legacy contracts. One final word pertaining to retail loans. Retail customers that are on SOR packages will need to transition as well. The Industry Steering Committee will be embarking on a media campaign in second quarter this year to educate the wider public of this important shift. Retail investors with SOR exposures should be hearing from their banks over the course of this year and the next on the options regarding their loan packages. In conclusion, as we enter 2021, I'm glad that we are starting the year with some good news, that with the IBA consultation, we are likely to have more time to manage legacy transition. Nevertheless, it is important to use this extra time wisely and sequence our legacy transition activities deliberately and purposefully. From the steering committee's point of view, we have made much progress last year in laying the foundations for the transition. This year, we want to maintain our strong momentum and achieve good depth and liquidity for SORA markets by the middle of the year. From there, I strongly urge banks to work with your customers to take advantage of good liquidity in both SOR and SORA markets in the next 6 to 12 months to proactively transition legacy contracts. If we manage to front load this work early and transition the substantive bulk of legacy books by early 2022, this will leave ample time for us to deal with any residual tough legacy transactions. That would be a good place to be in when we meet again this time next year. Thank you very much, and I wish all of you fruitful discussions for the rest of this webinar. Thank you.
Thank you very much, Mr. Leong, for this insightful address and really strong guidance in this very, very critical transition, and especially when it comes down to the new twist with the IBA consultation and the impact that would have on the market. So thank you very much for your time and for the MAS guidance. Let's go down a little bit more now in the weeds, if I might say, of the LIBOR issues. And I would like to introduce our next speaker, Andrew Ng, who's the Chief Executive of and head of the Treasury markets at DBS, will share with us the impact of LIBOR transition on the Singapore industry and key consideration for a smooth transition. So Andrew, over to you. And you're on mute.
Okay.
There we go.
Okay, you hear me?
Yes, we can hear you well and we can see you well, perfectly. No, now we can't hear you. Put yourself back on, you're on mute again.
Now it's okay, right?
Perfect, yeah.
Okay, thank you for having me. So I think Seng Chong just now, I think has really briefed you the timeline, right? And the landscape of the SORA transition. I think the most important thing, I think, for the bank or from a market practitioner point of view to look at is we all committed, right, to trim down our exposure of the SOR derivatives, right, progressively. So 90% by 2020, 70% by first quarter 2021, 50%, you know, by a second quarter 2021, and 20%, you know, by third quarter 2021. And of course, I think we also expect maybe from the second half of this year, there might be a kind of less liquidity on the SOR derivative, and they might even considering whether there might be a cessation, right, of the SORA derivative by end 2021. Then of course, I think the SCSTS, right, also have considered to by April 2021 they will stop issuing all the SORA a cash product. I think that would really help because I think from April onwards, then all the loan product will price in SORA, and then at the same time, I think all the bond issuance will also try to to issue in SORA. So I think that probably should be able to help to drive liquidity, I think, on the SORA basis market. Because I think for purely, for the derivative market to come up with try to trim down the SOR exposure, I think it's not that easy. But I think if you combine with the cash market using SORA, I think that you will be able to create a supply and the demand on the receiving side and the pay side of the SORA. So I think we probably will see the kind of liquidity should come dramatically more, I think, from June onwards. And then if we look at the so far, right, on the SORA derivative, right? So I must say that the kind of liquidity and the volume we have seen so far actually is not as good as we think, right? I think by end of last year, we have seen only a 0.14% of the SORA volumes compared to the outstanding SORA contracts. So that means the outstanding SORA contracts, we still have outstanding of over almost $1 trillion. So I think, of course, most of them would be like interbank trades. So I think the good thing is for LCH, right, they're going to extend the clearing to the 21 year from February 2021 onwards. And I think the kind of measures that MA has taken is to deepen, the SORA auctions, and then to have the SORA FRN program, and then to encourage, on the cash side to issue more SORA products. And so hopefully, I think this will all be able, to deepen the market. And then if I look at the data, right, I think in October 2020, I think the SORA volume is talking about something like 1.2 billion. But then I think if you look at the spread, right, I think of the SORA swaps, actually the spread actually has tightened quite a fair bit. We have seen the average of last year, we're talking about maybe something like 12 basis points. It down from 18 basis points now to the market is trading at around something like 5.5 to 6 basis points, which I think has compressed quite significantly. I think that is also a good sign that you have both sides of the market. And also, I think the bid ask, right, has also narrowed down something like to 1 to 2 basis points. I think this is also helpful because I think a lot of corporates, when they negotiate with the banks, right, on switching from SORA to SORA, I think because of the bank looking at the bid ask, I think they have kind of hesitation. Why I have to switch, because I have to hit all your bid ask. But now because of the narrowing of the bid ask spread, I think of the basis swaps, actually I think that will probably incentivize some of the corporates to move. Then of course I think some of the corporates, I think, still take and wait and see attitude to see how the SORA market grows. But hopefully, I think by May or June onwards, if you've seen more liquidity, I think in the SORA market, then I think you might see more corporates are willing to move. Then I think in terms of from a bank's perspective, right, I think it is the utmost important is to have your system ready and to have a very good risk management of your SOR exposure, and then potentially to see what kind of legacy portfolio you might have. So I think for the banks, right, I think it is important you have the scoop of all the trades across the bank. I think from the treasury to the corporate lending side, you have to have your internal and client education towards a new terms, the legacy transition process under the ISTA and the bilateral documentation. You need to make sure your system is ready for the new risk-free rate. I think you need to set up all the curve, from SOR discounting, to SORA discounting, and then also look at all the ISTA convention, and then you need to have, the operational process for in the rear fixing against the Libel in advance fixing, and thereafter to start work on all the legacy due transition. Then, of course, I think to build the SOR market liquidity, I think this is in the mind of every bank, I think, in Singapore. So hopefully we will get a deeper market, because right now I think if you see that most of the transaction still, is below 1 year or the 2-year tenor, even though we have seen some 5-year SORA basis has been traded. But hopefully, by February 2021, when the LCH can clear the SORA trade up to 21 years, then I think you might be able to see more long-term SORA basis quote. I think that will really help the market, because I think for some of the market participants or market practitioners, I think they do have quite a large chunk of exposure, I think, in the longer end of the curve. Well, as I just said, I think this is a engagement for all the functional units, right, across the bank. So I think that one is very important. You need to have your finance people, you have your risk people, your ops people, and the legal people, to address the concerns, from all the external concerns. So I guess for banks, so you really have to enhance your system. And at the same time, I think for risk manager, you also need to make sure you'll be able to identify, what is your SOR exposure, and then by end 2021, hopefully all your SOR exposure will decrease dramatically, and you make sure you have to see whether all this legacy portfolio will continue into 2022 or 2023, right? So I think from a risk management point of view, I think it is very important to make sure you will be able to see that. And at the same time, I think from a market head point of view or from a risk manager point of view, you also want to push push your traders, right, to put up the trade for compression and to join all the conversion cycle. I understand that some of the banks might be a bit stringent, I think, on the tolerance on the compression. So I would say that if we really want to be able to compress most of the trade, maybe you have to kind of increase your tolerance, I think, on the unwind of your trade. So I think there's something that I think our bank and some of the market makers, I think they're looking at. I think lastly, I think it's more or less, I think you talk about the so-called challenge, right? I think as Seng Chong also mentioned, you have a lot of syndicated loans, and then you will have swap arrangers, to hedge the swap. So you might have one syndicated loan, but then you have like one bank against many banks as swap hedge counterparties. So I think on that one, I think to be able to unwind on the legacy trade, I think that is potentially it will cost you some trouble. So it's not easy to coordinate, right? And then of course, I think if you cannot unwind some of those trades, and then you let these trades, to go into 2022 or 2023, they might pose a problem, because by end of 2023, you will no longer have a Libel, and then you have to get to the fallback, to the adjusted SOR. I think for that one, actually, it's a big uncertainty. You don't really know, first of all, at that time, whether you will continue to have a Libel, and then even if you have a Libel, they might have the tenor may not be continually to have the 6 months tenor. So I think on that one, so I think it is important, I think for the corporate people or for the risk manager to understand, it's not that easy for you if just say, oh, I just let the trade, to go to the fallback of the adjusted SOR, because then there are a lot of uncertainties whether you will be able to get a adjusted SOR rate. And furthermore, the adjusted SOR rate may not be clear, by the clearinghouse. So I think that one is something that we should all be aware of. Then of course, I think there are also people talking about, when the clearinghouse, when they go to use the discount curve, right, on using the SORA curve instead of using the SOR curve. So there might be some difference on the mark-to-market or some of the trade, for the customers. But I think for Singapore, since you look at the spread between the SOR and the SORA, actually the spread has compressed quite a fair bit. So somehow I don't think that would be a big challenge for the bank to agree on to the mark-to-market. So that one I think shouldn't be a problem. But of course, I think in other jurisdictions, I think you have seen the CCP has been compensating some of the the banks or the participants, because the spread is a fixed adjustment spread of a 50 basis point. Then of course, right, I think the last one I think is talking about the new risk-free rate derivatives, right? Even though I think in Singapore, in the past, maybe we still have quite a fair bit of saw derivatives on caps and floors or swaptions. I think lately, of course, last 1-2 years, we have seen this demand. I think from that has faded off. But I guess I think it is also important, if you want to grow the derivative market. I think in Singapore, I think it is important for banks to be able to build a model, and then to be able to book all these new risk-free rate on the new model. So I think for the structurer or for the banks, for the risk manager, I think you need to be able to build this model. So I guess to conclude, right, I think the most important thing for a bank or a book runner, actually what your fear is the loss of liquidity. So I think, as Seng Chong mentioned, I think the sweet spot, or you will get more liquidity, will be from June onwards this year to maybe October or November this year. So I think we should all grab this opportunity to try to move most of your derivative trade, from the SOL to the SORA through the basis swap market. Even though you have to unlink one side and the other side, but at least during this period, you still have the liquidity on both on the SORA side and the SORA side. But I think once you miss this opportunity, you might have been able to start with the position for a very long time, and then you will end up with all the uncertainties on the fallback, and then you do not have any liquidity for you to trim of some of your portfolio. So I think that's probably my advice, right, to the participants, the corporates. I think don't miss the chance, to be able to convert all your trades to SORA in the second half of this year. Thank you.
Thank you, Andrew, for this very good recommendation. I think especially around the window on the liquidity, and I think that will be extremely important that the switch will be made there. That's one, and certainly on the compression, I think that's clearly as well. I mean, as much as banks can reduce the number of contracts in their books as the transition goes through, the better it will be. Moving on now, we're going to talk about case studies. So we're going to look through 3 presentations, what that transition means for a certain number of type of clients through case studies. And for that, we'll have on this session Ryan Page, solution specialist at Refinitiv. We'll have Wolfram Hendrik, partner at EY, and Gaurav Kapoor, who's head of APAC head for risk and valuation at Bloomberg. So Ryan, I'll leave the floor to you. Just for sake of easiness, can I maybe ask you to pass on the floor immediately to Wolfram and then Wolfram to Gaurav, so that there is no retransition to me. Thank you very much. Floor is yours, Ryan.
No problems, Philippe. Thank you. Greetings, everyone. I think we have over 1,000 participants today, so it's an amazing turnout for what's shaping up to be a great event. It's an honour and a privilege to be part of the event and share with you some practical examples of how real-life clients are planning, preparing, and executing for the LIBOR transition. It was fantastic to have Mr. Leong from the MAS at the start, providing some clear guidance and clearing up some areas which I know, certainly talking to our clients, has been a hot topic of conversation since the recent consultations between the IBF and ICE. And also Mr. Nung from DBS providing a fantastic overview and some really detailed assessment from a market practitioner's point of view. I guess as a market infrastructure provider at Refinitiv, we're uniquely positioned to support and enable the overall consultation and implementation of an IBOR transition. Our client base is broad and diverse and is across all aspects of financial markets, including the buy side, the sell side, corporates. We work with government and academia. We provide tools, data and analytics to the front, middle and back office functions, meaning we have a role to play in understanding how the transition impacts client workflows, the market and firms as a whole. Before I go into some real life examples, I just want to think about the impact for clients and service providers. Next slide, please. So from a client perspective and a market participant perspective, the concept of the LIBOR transition is broad ranging, right? So obviously the conversation so far from Mr. Leung and Mr. Ng has concentrated in on the financial instruments, derivatives and loan aspect, which is front and center for most market participants. But it's important to note that when working with our clients across that broad spectrum of financial services, there are also other areas of firms' workflows that are impacted and need to be considered in a transition, including the accounting and financial reporting. I know the accounting standards have been updated to include new conventions around these, the adoption of risk-free rates, industry-specific users. So think about curriculum within universities and research that's written based on Libel all needs to be adapted and understood, as well as any internal reports that are run based on and using Libel, thinking about the historical and future impact of those. So from a client perspective, these are the sorts of things, I guess, that different parts of the firm will be grappling with and looking to understand. Next slide, please. From a market infrastructure vendor perspective, that takes shape a little bit differently, right? So when we think about this transition, the sorts of product enhancements and development that we've been undertaking to assist with the transition takes form of what's on the screen now in terms of calculators. So the ability to obviously price these new instruments against the new reference rates, compounding. You know, I think Mr. Ning mentioned that, you know, the difference between in arrears and in advance is something that's critical to the transition. And scenario analysis tools, you know, allowing our clients to look at what this change means to a portfolio. Analytics, all the different types of curves that are available and required now for a smooth transition. The ability to search and monitor new instruments linked to the new risk-free rates, understanding that composition of the market and where liquidity is heading, as well as a more generic overview and central spot where clients can go and look at not just what's happening within the Singapore market, but more broadly across the globe. The onboarding of third-party data, you know, obviously the fallback rates that are being published, the new rates, the new compounded indices, all of that third-party data needs to be onboarded and provided in a fair and transparent manner. Reference data, so, you know, all of the new fields to easily identify some of these instruments that are impacted, as well as fallback language is obviously critical to workflows, particularly in the middle to back office. And any of the benchmarks that are now forming part of the transition process. So I just wanted to set that up so that you can see, I guess, you know, from a market participant's perspective and a market information provider, you know, we need to bridge that gap. So working closely with our clients is critical on this transition. I think Mr. Leong mentioned that a strong public and private partnership is required for the transition to work. At Refinitiv, we firmly believe a strong partnership between service providers and our clients is also critical to tackling and addressing this transition. Next slide, please. So moving on to one of the case studies. So our client, one of the largest bank in their domestic market here in Asia, and principally engaged in the provision of banking and financial services, operating in three traditional segments in corporate banking, personal banking and capital markets. So I guess a true sell-side operator. As a result, you know, a large range of client instruments and products that are impacted, including derivatives, cash products, and their participation in bond markets. The point here around who we were working with is also really important. You know, depending on the clients that we work with, the LIBOR transition workforce or project team can be comprised, you know, sometimes of just people within a treasury function or more broadly across different stakeholders in the firm. Given my first slide where we see that the impact here is more broad than just, say, a treasury desk, the most success we've seen in terms of firms grappling with this is where the work group comprised of users from different departments. So in this case, it was market risk, the ALM team were well represented, the legal team and technology team. The last point here is I guess, feedback from not only our own account team that worked with the client, but also the client themselves. And it's important to note that overall, the assessment of the effort that was put in, we estimate, and I guess the client agreed, that it was about 80% of the time understanding what the transaction actually meant in terms of the client's operations and workflows. So I think, like we saw from the previous speakers, you know, understanding that at an industry level and then at your own firm level is paramount to setting you up for success. And then only 20% of the time was actually spent on the Refinitiv solutions to plug those gaps. So once the transition is well defined internally, our role as a market information provider to slot in the relevant content, calculators, analytics becomes quite easy. Next slide, please. So I guess just where we ended up with this client, and I mean, this is simplifying it a lot ultimately, and my colleague Dave Rickard will be speaking after this, will be delving into our platform a little bit more to show you the actual rates and the platform, what's involved. So this is a high level outcome of you know, the target state that we arrived at with this client. So derivatives and cash that were will be unable to be migrated and transitioned off the legacy LIBOR rates. Will rely on a fallback rate, and then the new risk-free rate instruments that are pegged to the risk-free rates will take a waterfall approach for cash products. So looking for forward-looking rates, term rates where available, and then falling back to a compounded in arrears approach for those rates and jurisdictions where a forward-looking term rate is not available. And the derivatives that are based on risk-free rates obviously will follow the market conventions around compounding in arrears. We'll talk a little bit later about some of the nuances and the architectural challenges around that compounding in arrears aspect. You know, I've represented quite simplistically here on the diagram. However, the implementation of that across a diverse set of systems that in themselves are probably as old and as legacy as LIBOR itself contains its own set of problems. So we'll just have a quick look at, for those derivatives and cash instruments that are based on LIBOR today and require a fallback rate, what that looks like in a little bit more detail. Next slide, please. Because although it's not the ideal scenario, and we've heard certainly from the MAS that, you know, the outcome should be everyone pushing towards a conversion to the new risk-free rates. You know, I think Mr. Leong did say engage clients now. You know, there will be some that are willing to come along and move and execute on that transition quickly. For those that are adopting a wait and see approach, you may find yourself as an instrument provider or as a participant in the market having to cater for both the old regime as well as the new. So for derivatives, again, it's relatively simple given the great job in terms of the guidance that ISDA's provided, and the adjusted SOAR, certainly testament to that here in the local market. But for cash products that are linked to LIBOR that are unable to be transitioned, you know, this particular client adopted, I guess, a three-prong approach in that they will assess a number of different options depending on the nature of that instrument and the rate that it's pegged against. So that would take the form of is the fallback rate in some instances, other official reference rates plus a calculated spread internally, plus or a forward-looking rate. plus a particular spread. So I just wanted here to illustrate that, I guess, particularly for this client who is large and somewhat sophisticated in their operation, there wasn't a one-size-fits-all outcome for them. And they are in a position where, to support, I guess, this transition over the course of the next few years, depending on when liquidity shifts sufficiently. And I think, again, Mr. Leung mentioned, mid-2021 through to early 2022 is a good indication of when we think SORA liquidity will outstrip SOAR. So there is potentially a time there where systems will need to be able to cater to both. So finally, just before I run out of time, the next and the final case study on the next slide, please, that I wanted to talk to was working with a local bank. Sorry, this slide here just, I guess, goes over the top of what data and solutions were provided as part of that previous state diagram. So my colleague David Rickard will be covering that off in the following session. So finally, another case study for a local bank that we worked on in terms of the cash transition that they're going through really boiled down to that compounding in arrears, which again was mentioned earlier. There are a number of different calculation methodologies that are available to clients to adopt in particular products. Being the look back, backward shift, and a payment freeze methodology. So implementing them into systems, loan and derivative infrastructure and analytics teams across the enterprise produces its own set of challenges. Like I said earlier, some of these systems are legacy to the point where they may have been around since LIBOR itself in the mid 80s, and as such, the thought of touching them and lifting the hood could be quite daunting. So from a Refinitiv Solutions point of view, we do offer the historical rates, custom tenors, those three methodologies in terms of calculating the compounding and arrears aspects and providing them through a single unified API with no additional hardware footprint. So, adopting the technology in terms of being able to plug in to existing systems and not having to go and touch each individual system, but providing it as a holistic capability to an entire organization. So I hope that's given a little bit, I guess, colour to how we're working with our clients. I look forward to talking to more of you within the market about how we can help. And I hope you enjoy the rest of the session. With that, I'll pass over to Wolfram.
Thank you, Ryan. I hope you can hear me all clearly. Honored to be here today. I'll jump right in, given the short amount of time that we have. I'd like to pick this up just from where Ryan stopped. I think he did a fantastic job illustrating to us the complexity that is involved in setting those rates and coming up with the various rates options. What I'd like to spend a little bit of time on now is to bring the discussion back on what ultimately matters most in all of this, and that is our corporate and retail customers at the end of the day, and how we communicate this most effectively, about this complex matter. So if we go to the next page, please. So as we've heard already in the introduction this morning, banks have already made a lot of progress on this. If I compare this to where we were at just 6 months ago in some of the IBOR programs, a lot has been done. The market is still working through some of the exact mechanics of restructuring and repapering, but banks have started to reach out to individual clients, particularly on the corporate side. However, when we talk to clients, what I hear from a number of banks that I spoke to in the last weeks, there's still a few issues out there, some of which we heard about. The aforementioned kind of fragmentation in rates will be even more so because you need to adapt this by sophistication of the customers and their product set. So what we've seen in banks is that some of them have come up with very, very complex decision trees on how to ultimately arrive at the rates being offered to clients in certain situations. And on the flip side of that, a lot of activity has been spent on making sure that the legal and the technical side of the systems really work and can cater to this abundance of different rates that might be on offer. We've heard a little bit about the regulatory developments, and there's more clarity emerging, but there are still things outstanding. We'll hear again in the coming weeks from IBOR and FCA on some further changes. So all of this, while good on one hand, in terms of giving us all more time to complete the transition, on the other side, it doesn't really help in breaking through the kind of wait and see attitude, because people are now looking to the second half of this year, as we heard about the liquidity. And there's obviously a risk that this gets drawn out and we wait too long for having the necessary conversations. So right now we still see and hear about relatively low adoption amongst corporate customers. They wait and see what happens. The rates right now are not very attractive in terms of pricing. So and of course, ISDA protocol is not that well established yet for many corporates. Fourth, there's value transfer. So banks are worried about understanding this better in preparation in the discussion for the discussion with clients, to understand how to best come to a value neutral arrangement that is fair in the market. And of course, the internal value transfer that is largely driven by FTP, which is also a hot button issue in many of our clients, right? How to set that right. All of this leads them to the ultimate question. So how, when, and what do we actually want to offer to our clients, and how do we communicate on this complex issue? So let me first start on the next page to recap briefly where we think banks should currently be at. And I'm not going to go through all of this detail. You can use this as a checklist and see whether you're indeed where you ought to be at this point in time. But just to hit a few points, right? You should have a client strategy. You should have a segmentation of clients in place, and I'll give you some examples in a minute. You should have all the tools in place that we just heard from Refinitiv about being able to calculate pricing for different rate conventions and product options. You should have detailed playbook prepared for different clients. Again, this is what I will talk about a little bit more. And you should have spent a lot of time already, hopefully, on training your frontline, having regular communication started, and very detailed training exercises kicked off to make sure that everybody is prepared to have those conversations with clients. I know some banks have already started holding client meetings on this. The coverage teams, sales teams are already out there. So we would expect clients, despite the timeline that we just heard about half a year until we're in that sweet spot, as we heard around liquidity. I think now is the time to slowly start with initial contract negotiation, particularly on those that are somewhat simpler or fall back on ISDA protocols and benchmarks. Next page, please. So here are a few examples from work with various clients here in the region. Some of those are from Australia, so you see here Sonia instead of Sora. But in a nutshell here, this is a four-point step around what sort of information you should bring to clients. First, of course, an overview, the agenda objectives of IBOR. A lot of that has already happened in initial communication. That already should be segmented by customer sophistication. Less sophisticated should get more background information to fully understand what's coming. You need to then second have a very good holistic view of the client holdings that you use as a basis for the discussions. The key here is that it needs to be comprehensive across cash and non-cash, particularly for clients that have hedges or hedge-linked loans. Possibly you want to differentiate this again by groups of companies where you have multiple layers of organizational structures. and trade finance specific clients that have different needs, right? As a side point, trade finance hasn't really featured in the discussion much yet, but obviously is an important part of the business here in Asia Pacific. So I suggest banks, if you haven't done that yet, turn some attention to that, particularly particular products that are discounted trade products will require the term rate. And so what we heard about the developments on the market side to get those rates in March, April are very welcome and important for trade finance. There was just a question whether the slides will be shared. Yes, they will be shared afterwards, so you don't have to take furiously notes while we talk. Third, obviously you want to have a financial impact assessment and a comparison between the different options. Ultimately, as a bank, you don't want to offer all the options, right? This is too complex. You need to bring this down and make this easy. You want to arrive at a point where you can offer clients several options, explain to them and say, this is ultimately where the industry is going, right? But a focus needs to be on reducing conduct risk overall. You don't want to give advice. You want to advise clients to seek independent advice. But you want to show different options and illustrate the financial impact, the differences around variability in outcomes to your clients. And finally, you want to ensure that in contract negotiation and the related processes, again, highly differentiated by sophistication and product situation of the client. So what do I mean by that? If you flip to the next page. Very quickly, this is an example from client work, differentiation by sophistication of client and type of products that they have. Obviously, there are smaller clients, they're sophisticated, where you need to spend more time. It's a multi-stage conversation that needs to be both written and in-person conversations to make this happen, whereas the most sophisticated players will largely be there themselves. So when everybody's ready, I think you can pull the trigger. And it's a much quicker procedure. But what I'm meant to say here again is whatever you do and plan in terms of customer strategy and communication should be segmented along these lines in some form, at least 2, if not more, customer segments on the corporate and then, of course, on the retail side as well. Next page, please. I would assume that most of you, if not all, now have playbooks in place. If not, it's urgent time you do that, at least in a draft form. It should be ready to go now. Our experience here is while on the one hand side, you want to have a very detailed playbook that lays out all the different possible rates and situations that you might face with clients in a handbook. Ultimately, you need to keep it simple and bring it down to something that is more easily digestible, right? Your sales and client service teams, particularly on the market sides, don't have time to deal with long playbooks. I've seen 60-page, 100-page PowerPoint playbooks in banks. These are necessary, but ultimately, you also need to complement this with shorter materials in order to really make things happen at the front line and make this work. So a very key point to keep in mind here. Next page, please. Okay, just to sum up a few points that I didn't cover here. Internal training is very, very important in all of this. We have helped clients come up with very detailed training exercises. You need to do multiple rounds so that things sink in. You need to be in sync with the market developments. As we heard earlier today, you want to time this correctly so that your teams know well when certain trigger events are likely to happen in terms of the liquidity, in terms of regulatory changes that are upcoming. So it's an ongoing improvement effort rather than a one-off training and then you expect your client service teams to run. That's certainly not enough. You need to be very clear about governance accountability across the entire organization. I talked about client assessment and segmentation that should be specific to the sophistication of the client. We will hear about conduct risk later in the bank panel. And then ultimately have a tracking mechanism in place where you get market-facing teams to track your conversation with clients so that you have a full picture at any time of what's happening. Thank you. Next page. I need to come to a close here. So just the last few points. Value transfer in all of this is inevitable, right? It's inevitable because it's not possible even on a single contract to match the cash flows exactly. The simple spread adjustments that we're looking for as industry solutions, they can't get exactly right. And that, of course, it becomes more complex if you have a whole portfolio of swaps and assets. The message here really is that banks need to be flexible. The basic permutations are simple, right? Restructure as a preferred option or add more robust fallbacks. Those are the preferred ones. Then alternative, do nothing or terminate trades. The less preferred options. You want to get this across first and then go into the mechanics and the economics behind this. What all of this needs, yes, we will be sharing the deck, another question there. What all of this needs is for the bank to really have the analytics in place to understand the value transfer for all the different options that you put in front of customers. We want this to be a fair trade, while it won't be perfect, in terms of a value neutral outcome, particularly now where we're in the low interest rate environment, the actual financial impact can be quite small, but you need to be able to calculate it and you need to be able to clearly lay it out for your customers. Good. With that, I would end my part and I'll hand over to the next speaker. Please go off.
Thank you, Wolfram, and good morning, everyone. Thank you for joining us today in this very well-timed event, and a sincere thanks to ASIFMA and ABS for extending this opportunity to be with you all today and share a few thoughts. The educational drive has been so widespread that there is now little excuse for market participants with LIBOR-based products in their portfolio to not have a transition strategy in place. Nevertheless, with less than a year to go before LIBOR's scheduled demise, significant complications in the practicalities of transition-related activities still remain, and which leads to a variety of approaches, often depending on the jurisdiction and the underlying product. For the three different case studies around risk management that I'll be discussing will mainly focus on SOFR, but the concepts are the same and interfungible with SORA or any other established risk-free rate. If we were to move to the first slide, as we consult with and help out our clients in the region, the one thing which is very clear is that the risk management journey attached to IBOR transition has just begun. The different ways in which an organization will be impacted is spread across many areas. From a front office consideration of position management, hedging, and valuation, risk considerations around curve construction, model reviews, and market sensitivities, and collateral management. We spoke about legal ramifications around contract renegotiation and repapering with inclusion of fallback provisions, hedge accounting implication around effectiveness testing, and lastly, but most importantly, a review of the legacy technology stacks around trade capture, payment systems, and intercompany funding arrangements. Andrew echoed the sentiment earlier in his presentation today as well. If we move to the next slide, this brings us to our first case study on cash markets, which describes how we have successfully partnered with a lot of financial institutions in the region to resolve some of the most basic, but yet technologically challenging issues. And we can call it as addressing operational risk. Now think about a cash bond or loan book at a bank. Usually, these legacy ALM or core banking systems have been built to handle forward-looking term rates. The need is for systems that can support risk-free rates, which do not function in the same way as their LIBOR counterparts. To ensure risk-free rates and daily compounded or average payments take place on time, systems need to be able to facilitate mechanisms such as lockouts, lookbacks, and payment delays and any averaging or compounding conventions as they are critical characteristics of any RFR-based payments. If we were to move to the next slide, it showcases a quick example of the complications arising during implementation. As risk-free rates are overnight and backward-looking rates, any average of a daily RFR over any period is known only after the close of the business day, on the last day of the period, or the immediate following day. Hence the need for a look-back period. Essentially, interest being calculated over an observation period which lags the first day and last day of an interest period, similar to the practice in the FRN market. However, the observation period referred to above is different from the interest period. It starts and finishes earlier, right? And this difference gives rise to some debate on whether it is appropriate to use an observation shift when looking at the weighting of the days in the relevant period. As risk-free rates are not published on non-banking days, the applicable RFR could be used for example, on a weekend period, could be used for Friday, Saturday, Sunday, right? Giving rise to a weighting for that risk-free rate for multiple days. Hence, for example, revolving facility agreements may not use observation shifts and instead use the look back without an observation shift. Moving on to the next slide, this was just a look back versus backward shift, right? Imagine now other complications as different averaging or compounding conventions, lockouts, payment delays. The party just keeps getting better. But really, after dealing with all of this complexity, what is the most basic end goal for a bank or a custodian managing a loan book? Calculate effective coupon and interest rate, total accrued interest amount, and effective rate at valuation date. And the decision for this large financial institution was really between doing an expensive complete tech stack overhaul or just expose the underlying trade parameters via an API environment and get the end outputs to feed back into their existing core banking systems. The next slide really just showcases the actual implementation of the workflow for a large bank in the region. Really, the idea was to create a solution that was non-invasive to their tech stack, but delivered both single security and portfolio level analytics, including stress testing capabilities via the API environment. We also created a Python-based web API application that allowed users in the middle office and back office departments to interact with the analytics in an easy to understand user interface. The next case study is for derivatives. The front office risk management challenges that we saw during the big bang discounting switch at clearing houses in October last year are just the tip of the iceberg. Clearing houses have played a significant role in encouraging the adoption of RFRs, as the major changes in price alignment interest that took place in 2020 enabled more hedges to reference risk-free rates. For example, in the US, the migration of Fed funds discounting to SOFR has helped boost activity in the longer end of the SOFR yield curve for basis swaps. I won't have time to go through in detail all the use cases across each risk framework, but one of the front office cases that we have worked upon recently with a large regional bank was on their advisory sales desk consulting their corporate clients on timing the transition. From a cost-benefit perspective, many firms are weighing the pros and cons of a proactive approach versus potentially doing nothing. Such firms may analyze the potential cost of exiting exposures in LIBOR derivatives by looking at the bid-ask spread or the potential value transfer from the mark-to-market on the LIBOR derivative versus the SOFR or new RFR-based replacement, right? The previous speakers spoke about this in detail. They may then juxtapose these costs with potential scenario analysis and outcomes if the LIBOR derivative remains on the portfolio post-cessation and triggers the ISDA fallback calculations. Understanding the different approaches, potential costs, and benefits is a vital part of any transition strategy. And that is something that we've been working on with the sales advisory desk that they can consult with their end corporate clients on. With market risk and FRTB, for example, IBOR transition will be responsible for a major shift in market liquidity as firms replace their LIBOR referencing derivatives with alternative reference rates. As activity moves away from LIBOR, we'll observe more non-modelable risk factors or NMR risks, right? Now, given that the test is conducted over a one-year period, there is a delay between liquidity picking up and a risk factor passing. So if the transition is completed by end 2021, there should be enough liquidity in risk-free rates before FRTB comes into effect in 2023. However, if it continues to drag on as there's some confusion in the market and as the US, there could be issues cropping up, right? Within Bloomberg, from a general market risk analytics perspective, in October 2020 last year, all the existing clients who were using OIS discounting for swaps and FX derivatives were migrated successfully from using dollar OIS discount curve based on Fed funds benchmark to SOFR benchmark. Last year, we made the switch to SOFR curve in our analytical functions where applicable, and within the market risk function, the discount curve switch was across all its risk measures, including VAR, stress tests, sensitivities, and FRTB capital calculations. The SOFR OIS curve is had to be backfilled back to the 1st Jan 2007 as well, and that then complies with the stressed historical VAR requirements. So you can really see as to how this becomes a very complicated task fairly soonish. The next slide, or the next two slides, they really just showcase how some of the banks have implemented what-if analysis tools to understand the impact of changes in discount curves on their portfolios, as well as what-if calcs on key rate risk reports in a multi-curve environment. And this is seen on this, the next slide. Yeah, exactly. So this is the what-if calcs on key rate risk reports across the multi-curve environment, right? So this brings me to the last case study around accounting reforms. So if we were to move to the next slide, in August 2020, the International Accounting Standards Board issued Interest Rate Benchmark Reform Phase 2, essentially amending IFRS 9 and IAS 39, among other standards. The changes aim to smooth the transition away from IBOR as a reference rate at the end of 2021. The amendment is trying to give entities the relief that if they are making changes to the contractual cash flows in a contract, whether it's changing the contract itself or just changing the basis on which the cash flows are being calculated, as long as that's all they are doing, they don't have to worry about anything. You get to update the effective interest rate, right? Similar with your hedging relationships. If all you are doing is making changes required by the reform, you really don't have anything to worry about. Now, I won't go through all of these points here, but ISB has been very helpful during this transition. And if I was just to take the last point under hedge accounting on this slide, which talks about group of items, where the relief allows the allocation of hedged items into subgroups. An example is macro hedging, where you have multiple loan underlyings with different underlying indices that are transitioning into new risk-free rates at different times. This allows the entire hedge relationship to continue by dividing these portfolio of loans into different subgroups and assigning hedge relationships accordingly. Now, there are various scenarios which could result in ineffectiveness. But as a starter, I'm going to use the most simple use case, that is a fair value hedge where the loan and the derivative transition at exactly the same time. So if we were to move to the next slide, basically, this just shows a 5% fixed rate loan paying semi-annual basis, and for purposes of hedge accounting, we're only designating the risk component of 2.57%, which is the interest rate risk component, right? The slide afterwards basically shows the hedge instrument where you receive, if you could move to the next slide, the hedge instrument really basically where you receive 2.57% and you pay 3-month dollar LIBOR, which is essentially the par swap. And the next slide showcases a quantitative prospective regression test where the hedge is effective and the parameters of slope, R square, are all in line and close to 100%, right? If we move to the slide after this, what I'm basically doing over here is basically moving from LIBOR discounting to SOFR discounting, right? And my swap effective coupon becomes 2.31%. And similarly, on the next slide, you will see that the loan coupon rate is also the same, 2.31%. Essentially, we are keeping this NPV same as the swap, right? But that is different than the 2.57% you basically saw earlier. And this basically brings me to the last slide on the presentation, where when you transition on the same hedge to the new risk-free rate environment, you can see that the hedge continues to remain effective, right? And this is where we are pointing out, if you like right at the bottom over there, where it basically moves from 30th June 2020 to September 2020, where we included the new risk-free rate as the discounting framework. Both the exposure as well as the hedging instrument, the effectiveness test is really kind of consistent of what we saw previously, right? But that is the most ideal scenario that we basically spoke about. The key points of consideration for any system being able to handle this, according to me, are basically two main points. First, it should be able to handle the new risk-free rate environment, both for cash and derivative products, whether it is data, accrual calculation, or the underlying pricers valuing these instruments. And the second, history is documented and maintained within the same hedge relationship, even after you make changes. This is an extremely important audit point. Now, this is a simplified example. But think about a scenario where you're dealing with a cross-currency swap and there are different currencies, different benchmarks, and they're transitioning at different times. Now that gets complicated, right? Now the nice folks from EY, especially Quan, will be giving a very nice overview of the problems in hedge accounting using 3 different scenarios, which I would urge everyone to tune into later on. And that really brings me to the end of the presentation. I hope everyone found it useful. And if there are any questions or queries, please do submit it in the chat and I'll be happy to take a few. Thank you.
Thank you very much, Gaurav, and thank you, gentlemen, for the for sharing the experience with your client. Indeed, I mean, for the audience, if you have questions, don't hesitate to put them in the Q&A. So we'll try to answer them as they come. Otherwise, there will be a small session at the end of this webinar. Also, just to clarify, there will be in the next few days on our website, you will be able to have you could rewatch the entire webinar, so it will be available for streaming. But also the slide deck that is visible here will also be available on our website at the same time. So as some of the speakers were mentioning, you don't have to rush to write and scribble everything. The deck will be available for you to consult and download. So I would like now to move on to David Ricketts. David is a global director trading desktop, FX, money market, and derivative at Refinitiv, and he will share with us issues around data transformation and implementation. David, over to you.
Thank you very much, Philip. Please let me know if I cannot be heard by waving or something. And thanks so much to the previous speakers today. It's been very, very interesting from my perspective to listen to the different aspects that everyone's looking at. So only here for a few minutes, so I'll push on, if we can, onto the next slide. So from Refinitive's perspective, much like the previous speakers, we're trying to work with everybody across where it is their exposures actually lie and how we go about the process to ensure that there's a smooth transition and remove as many risks as we possibly can as we go through that process. There's a slide here just in regards to the history of what's happened and where we're going to. We know that from the previous speakers that that the process of LIBOR transition or IBOR transition has been managed differently and has slightly different timeframes to what was originally expected. And that's because of the ability for the local regulators and central banks to find the right system which is going to adopt and be suitable for their area. And full marks to the MAS in Singapore, because I think regionally they've done an outstanding job working with all the associated groups to ensure that visibility of the process and timing is about as good as anywhere in the world at the moment. So that certainly bodes very well for the strength of the use of the Singapore economy and financial markets. And going forward, I'm sure that's going to play out very favorably. If we can move on to the next frame, I guess with, as everybody said, the slides will be available to all participants at the end. So some of these I'll move through quickly. If we could just go back one, actually. So what we're really looking at is for transition and implementation. And as I put there from the heading, it's not, even though it is moving on to risk-free rates, the transition itself is by no means risk-free. And that I guess it's really important that organizations, as we've heard previously, that they really understand, how is their business ingesting? Where are there risks involved in this process of transitioning? It's not just a matter of buying some terminal from an organization and just feeling as if that's going to solve everybody's problems. So what we're really looking at is, how have you, the process of going through mapping your exposures, understanding what they are, understanding in terms of the instruments that your organization may have exposure to or that you're providing to clients in the market, understanding that there's going to be a period of time where organizations are very likely to have to run parallel calculation capabilities and looking, as we said before, at multiple curves to realize the different risks and calculated sort of hedging requirements and calculation periods and methodologies. So these are very important for people to understand where their exposures are and how to measure those. I suppose the other things we need to be looking at is that when we're looking at the actual methodology itself, how is that going to be integrated into your systems? As to Ryan's question or point earlier today, legacy systems are not necessarily really well designed for the new forward or backwards looking requirements of a lot of products and the way they're going to be calculated going forward. So this in itself is as much an IT sort of infrastructure transition as it is the actual type of data and pricing that you're ingesting. And I suppose the other part of it is you have to build in all sorts of new curves, which need to be both referencing the existing IBOR designed rates, or you also need to be able to look at in parallel the new risk-free rates. And to Andrew Ning's question around, how that introduces different types of risk from a basis perspective, from where your client's exposures are to what your underlying fundings are, and then actually how your internal systems calculate all these different things. With Refinitiv, there's multiple ways which we will work with clients as we have across the region. The methods of which businesses need to be able to access data and consume data can be in multiple different ways. We have systems like DataScope that have been around for many years, where we've actually had to make sure that we're capturing the methodology of the underlying instruments, ensure that it has the correct fallback provisions and information which is going to be required by looking at the instruments and exposures that your clients have at looking at their existing contracts. And then there's ultimately decisions that clients and banks will have to go through as to, do you maintain the existing instruments that you have? Do you renegotiate them onto the new risk-free rates, effectively blend out of an existing instrument or derivative or combination, and then move across to the new rates. So I suppose there's probably some of the first sort of areas when it comes to the transition. How is your business placed? What map do you have in place for that particular process? And can you access all the new types of information and ingest it into the systems which you're going to be reliant on throughout 2021 and obviously for the next few years? And bearing in mind that when you go through this particular process, it's not simply a matter of maybe you only have Sing dollar exposure, but how is your funding actually looked at? Where is it generated always in Sing dollar? Are you looking at US dollar exposures? Are you looking at, into the yen markets and into sterling or into euro markets? Now, as you go through that process, each of those particular locations has different timing. As we know, it has a different availability of products and pricing and information. How are you going to access that? How are you going to ingest that? And how do you need to actually use it for calculation purposes? So then obviously clients will need to look at how there's the requirement for potentially repapering contracts that exist, and there's the requirements for the legal teams to understand the full the impact that this has. And you need to have genuine conversations with your clients as to, are they prepared to maintain existing contracts and then rely potentially on fallback language, or alternatively, they have a period of time before really these fallback language is really required. Perhaps potentially they could look at repapering contracts onto risk-free rates and avoid those issues. Easier said than done. Like I said, the transition to risk-free rates is not risk-free. All these have to be weighed up by clients. Then I suppose we're sort of looking at the implementation, like the actual sort of physical way of which we are connected, or clients connect to the services, the data providers as well, for the different areas. And it may be one particular organization you work with, or maybe it might be multiple organizations. So ensuring that the infrastructure is actually there. You have some areas of your organization may need to have live information all throughout the day, whether it's front office areas, or whether or not it's actually into different parts of your teams and businesses where you're really looking at end of day provided information. I suppose this is probably the next part of it, is that we also use this opportunity to review how everyone is consuming data, and the process of which maybe there might have been some legacy processes and ways to consume data, which is now, it's time to review that methodology and perhaps move into a more compliant and audit-proof environment or way of consuming information and consuming data. I guess probably down to my sort of third last point there, which is really to make sure that the businesses understand that you need to future-proof what you're doing, not only for the purposes of this transition, but also for the breadth of products which you may be required to show clients in the future, and understand that now is the time to do that work to ensure the infrastructure and ensure the data is there, and connectivity is done, not only for the, let's say for the SORA market as it starts to open up and improve liquidity, and we get, obviously more issuance, which allows for more derivatives, and the two of them combined will hopefully start to expand the market there. So these are sort of part of the things that we've been looking at Refinitiv. When it comes to sort of term funding and term loans, Refinitiv has really sort of taken a front foot here in the sterling market. So with SONIA rates now available through our platform, and as we've discussed today, SORA will be looking at sort of more term structure pricing products available throughout our systems, and I'm sure many other systems which are available or providers in the market. So we, as Refinitiv as an organisation, and working closely with the LCH as part of our broader organisation these days. So just moving down through my next slides, if I can. On our platform, users will be able to access all sorts of different information if they need, in terms of, we have IBOR transition applications, and if we can move the next slide again. We have OTC instruments, not only looking at the SORA markets, but the basis, which becomes very, very important for clients and providers to access. Move to the next slide again. We have looking at the finding in the market SORA-based instruments and also the new other risk-free rate-based physical instruments, so the bonds and similar loans which have been issued to the market. If we just jump to the next slide again, we also have looking across all the derivatives which are risk-free based as well now. So this is really part of that process of really understanding where is the market now. As Andrew's point, the spreads are changing. You need to be able to monitor this information, and it needs to be able to be consumable visibly and also on a data feed. If we move to the next slide again, the curves which we've talked about, whether they're zero-based risk-free rate curves and actually monitoring their movement or looking at their parallel shifts, is really critical for clients to understand that this is not just purely about taking a feed. This is a combination of feeds ingesting into your internal systems and visibility in terms of actual user seeing live movements in the market and comparing what they actually need from that perspective. If we just shift on to the next one again, and to the same point that we had previous speaker, that calculators are ultimately part of this process, which you really do need to have access to. This is not something that's very easy to do on Excel spreadsheets anymore. So, all calculators and applications need to have the ability to easily provide the information under the existing IBOR regime and under a SORA regime or any other risk-free rate. And if we just click ahead, we'll move quite quickly through these. I'm sure everyone will have access to these slides later on if they need to. If we just jump onto the next slide then. Maybe just hasn't updated for me. And this is to go through the fallback information and language in case, it's often talked about process fallback languages and how do you actually get hold of them. Refinitiv is an official authorized redistributor of the ISDA fallback rates. This sort of information might come across as rather sort of odd at first, but then when you first start to see it and you realize how it can be used and then link back to products. So, and we can probably just shift through the second last slides now. If you are an organization that's looking through the particular process there, we have the SONIA rates now available, which are like term structured rates, which can be used for loans, for term financing, etc. You need to be able to work with providers like ourselves and others in the market to access all the information that you need for your various feeds and internal systems. And that will help reduce the risk of moving to a risk-free environment. So I think that's probably about where I need to finish from a time perspective. Philip, I may need to pass back on to yourself.
Thank you. Thank you very much, David, for this very comprehensive presentation. Thank you so much for that. We will now move, and I think Roraf was mentioning that a bit earlier, we will move towards the accounting and tax issue. And for that, let's bring Mr. Rajesh Bhimani, partner of financial services transfer and pricing at EY, and Kwang Chi, who's also from EY, is a partner on quantitative analytics and treasury services. So Kwang and Rajesh, the floor is yours.
Right. Thank you, Philip. I hope you hear me well. Right.
Yes.
Yes. Thanks to Gareth actually for the accounting segment. I will be focusing on more on the hedge accounting. Although in this IBOR reform itself, from an accounting perspective, there are certain topics that surfaces, such as the derecognition test, disclosures, and leases as well, right? So in particular, I think in this next 7 to 8 minutes of mine, I'll focus on hedge accounting. In particular, how to minimize ineffectiveness while transiting from the new ARR to SORA, which is, I would say, a key questions from the buy side between the treasury team and finance team that typically I meet and discuss about very often. Therefore, it is imperative that from the sell side perspective, it is even important that you understand all these issues and how you could assist your client in this reform journey. All right, next slide, please. Okay, next slide. And yeah, one more slide. So for the start, I'd like to do a very quick recap in terms of the reliefs available for the hedge accounting. The hedge accounting is split into two phases in terms of the relief. So in layman terms, I think I would just try to explain from a phase one perspective is that any contracts that is before the replacements, right? The ISB is aware that the application of existing hedge relationship faces a lot of uncertainty in terms of, say, what would be my cash flows going to be due to the changes in benchmark rate reform. Does this trigger the questions of there is no longer any economic relationship and so forth because of the uncertainty? They are aware of this. Therefore, the application of this relief could help minimize the de-designation of the hedge relationship due to all these issues, right? So there will be a point in time where you need to transit over to be it your hedge item or the hedging instrument in the amendment of the replacement. Of course, the worst case scenario is that you may have a situation whereby, say, the existing SAW derivatives contract, you unwind it, right, and you repaper it to a new contract based on SORA. Now, both of them are two different contracts of, one being used in the previous hedge relationship. Does that mean that from an IFRS 9 perspective, you will have to discontinue the relationship because IFRS 9 do not allow changes to the hedge documentation? This is when the phase two addresses this to avoid any systemic discontinuation of the hedge relationship due to the amendments in hedge documentation. And of course, as highlighted by other speakers earlier on, if these changes are necessary as a direct consequence of the interest rate reform, of course, you don't have a lot of the implementations. Now, the questions I often get from the buy side is, oh, great, I have phase one relief and phase two relief. And in their mind, there is no ineffectiveness. Unfortunately, this is not the case. So let me address this in the next slide. Now, in this slide, I will illustrate in three different scenarios or three different buckets. In scenario one is a situation whereby the reference rates and the observations are mismatched. For example, the fallback rate for the loan, for this case, let's say it's a compounded SORA plus a certain adjustment. The derivative is a fallback SAW. The timing of the transition is different. One is earlier and one is later. What is even more interesting is in this scenario, the interest observation and accrual are different bases. One is based on a compounding in advance and one is in arrears. In this situation, you would see that it's a list of mismatch. And because of all this mismatch, it resulted in potential issues of the ineffectiveness. If we were to move to scenario three, right, where we have a critical term match situation, both the loans and derivatives are aligned in terms of fallback SAW or compounded SORA. The timing of the transition are the same because sometimes if you have the bank that is providing you the loan and your swap bank are the same, it's a lot easier in terms of the negotiation. Interest observation and accrual selected to be the same in terms of compounding in arrears. Therefore, it is very unlikely to have any ineffectiveness in this scenario. Now, what is interesting is scenario two, which looks very similar to scenario three. You can see that scenario two, where we paint a situation where it's a same fallback, right? It's the same fallback. Interest observation are the same, but the only mismatch is in terms of the timing. Now, because of the mismatch in the timing, there could be opportunity whereby the negotiated adjustment for the loan and the derivatives are different based on the market rate, right? And the good thing to hear from the earlier speakers is that all these gaps are narrowing down, right? And to a point, I think about 5 basis points, and of course you have your bid-ask spread as well. But I think the key issues is also that I think with the current tightening of the spread, there could be potential widening going forward because of the potential lack of liquidity in the SOR derivatives, right? So scenario 2, a situation like that could be more of an interest differential that resulted in the ineffectiveness needed to be charged to P&L, right? Let's move on to my next slide, which is the last slide for the accounting. I think the earlier speakers has already shared quite a significant bit in terms of the spread adjustment and so forth. I have put on a chart here to illustrate in a very layman way, instead of analyzing the of course the basis spread between SOR and SORA, but just looking at the spot itself, right? And we have intentionally moved the compounded SORA of the publication by 3 months earlier, so that it makes the comparison a lot easier, right? The yellow line here depicts the 3-month SOR. I think it's a dark gray, or the black line depicts the 3-month fallback SOR. And of course, the 3-month compounded SORA is depicted in the red line, right? You can see that very much earlier on in June, the fallback SOR and SOR itself are quite similar, I would say. Maybe at a point in time, if you had negotiated, you will end up to have a compounded SORA plus 10 basis points, right? Which is depicted by the dashed red line. Now, imagine, if you time the different transitions itself and waited 3 months later into, say, September, you will see that in that situation, it has, there's some divergence over there in terms of the spot rate observed. You may end up with a situation where the negotiated spread is a compounded SORA plus 15 basis points. So therefore, the timing is essential to avoid any ineffectiveness. And if I were to just summarize, right, to achieve the high effectiveness, the traders or the risk managers, or even the RM, something to be mindful of is to understand your clients or your customers, their needs, and whether they are using it for the hedge accounting or adopting hedge accounting. Achieving high effectiveness can be addressed by the 4 points, which is essentially making sure reference rates are the same, timing of transition, interest observation, and of course, no other non-IBOR related terms of repapering, right? So I end off my session for hedge accounting. I'll hand over to Rajesh.
Hey, thank you so much, Kuan Eng, and very close to good afternoon all. Just 2 minutes to 12. Can we move to the next slide? In the meantime, I hope you can hear me clearly. And before I get started, thank you so much, ASIFMA and ABS, for the opportunity. And special thanks to my fellow speakers for the insightful summary. I think extremely well laid out, which helps me to talk a bit more around tax now. So if we talk about tax, I think the present structure of the interest rate market is either based on LIBOR or SOR. And IBOR discontinuation or decommission, for example, from SOR to SORA, could pose several tax issues, and tax issues ranging from corporate tax, transfer pricing, and even other operational tax issues like stamp duty and withholding tax. So let me briefly touch upon few of the tax consideration. And the most important is from the accounting treatment and implication arising from modification of the financial instrument, and whether due to the shift, the tax treatment will follow accounting or not. So at this point of time, if you ask me, IRS in Singapore has not come up with any clear guidance. And the working group under the SCSTS, along with the ABS tax committee, have been working hard and has also approached IRS to ensure that we have some guidance around how IRS will consider the transition. But if you ask me, and if IRS has to follow the previous changes to the accounting rules, then tax will follow the accounting. And what does that mean is that any transitional P&L, for example, from modification of a loan or even ineffectiveness arising in an hedge accounting relationship, would hit your profit and loss, and therefore would either be taxable as profit or loss as such, right? So what does that mean is that understanding and quantifying the amount or the adjustment is extremely important. Now, the real financial or tax impact may not be significant, and specifically for the banking entities, because Singapore, we follow both realized and unrealized gain and are taxed as such. So while a gain may be realized at a time of transition, the corresponding day one P&L of the replacement of the instrument may result into a loss, which would offset the gain, right? I think another important consideration from a tax perspective would be on transfer pricing. So in most of the cases, this would lead to a little problem, but for transfer pricing contract that relate to floating rate instruments or contracts, whether maybe USD LIBOR or SOR, you would be required to change the document or the reference rate. So the repapering exercise, and also need to consider how one would then benchmark those rates for intercompany funding purposes. In particularly talking about intra-group agreements or intercompany agreements, important to ensure whether there is an existing arrangement which talks about any fallback provision or a clause. So this would need to be analyzed closely. Let's say if the provision does not exist and the intergroup agreement would then need to be amended, which would basically mean that you would need to put in place or amend the existing agreement. From a transfer pricing documentation perspective, or probably from a tax office perspective, you would need to explain the changes and also include it in the documentation as such. Another important consideration to highlight from a transfer pricing consideration perspective is that whether the tax authority would view the transaction as a new pricing event or would consider a price adjustment under the existing terms of the loan. This is an important consideration because let's say if a new pricing event is triggered or the tax office assumes it to be a new pricing event, then basically you need to evaluate all the factors of the funding arrangement. You need to evaluate the credit risk of the borrower at the time of the change, vis-a-vis whether it is just merely a change in the terms and condition. Another important consideration from a transfer pricing perspective would be agreements with tax authorities. So many corporates and banks would have agreements covering funding arrangement with the tax authorities, what we call advanced pricing arrangement. Few countries also have thin capitalization agreements as well. And also the shift would impact these agreements or arrangements. So basically you would need to speak to your tax authorities how this funding arrangement, both intra-group or third party, would impact those agreement with the tax authorities. As far as thin capitalization is concerned, Singapore has not implemented the thin capitalization at the moment. Howsoever, I think important to highlight that these when it comes to transfer pricing, you look from both country perspective, from a lender and a borrower perspective when it comes to intercompany funding. So you need to ensure that there could be potential TP controversies with different countries adopting different benchmark rates, also adopting different adoption dates or stagger adoption date, which could lead to double taxation. And basically the tax authorities could have different view as well in relation to the reference rate as such. So it's important to ensure that you do follow closely to your local tax authorities in relation to these reference rate or adoption of these dates. Can you please move to the next slide? Sorry. Yes, thank you. I would broadly categorize this slide as other operational tax issues, as I mentioned, such as stamp duty and withholding tax, right? We believe that there should not be significant impact on treatment of stamp duty and withholding tax. So specifically talking about stamp duty, some of the contracts, if they were subject to stamp duty when they were first taken on, so say example, sale of any stock, shares, or even interest therein, as they are repapered, the stamp duty could potentially arise or technically arise. Now, this is one of the things we would like to clarify with the IRS, and at this point of time, it is something to make note of. So largely, there should not be any stamp duty implication, but let's say if initially there was a stamp duty when the instrument was first taken on, that there could be a potential impact. In terms of withholding tax, there could be some impact to non-banking corporates. So basically, if you ask me, yes, for banking corporates or even approved financial institution that has a blanket exemption, the exemption will continue to be covered under the transition. However, for a non-banking entity, they would be subject to withholding tax, and also the one-time adjustment or payment would also likely would be subject to withholding tax. For the companies that have specific loans for which the finance minister has granted exemptions, such as the technology or economic development companies, right? Those companies would have to resubmit the amendment of the loan to the regulators, and also need to ensure that whether they continue to enjoy the withholding tax exemption. More important to carefully review whether also the one-time payment adjustment would also be covered under the withholding tax exemption or not. Similarly, for other corporates, there could be other operational tax issues. For example, whether the one-time adjustment would be taxable, tax deductible as interest, or it would be something like a cancellation fees. Just conscious of time, and to summarize, and look, I think all the other speakers already mentioned, and I would recommend that staying close to treasury, finance, risk, and also I think importantly, the tax team as well, to understand what are they doing in terms of the IBOR transition program, how have they positioned themselves to defend these positions. And also I think it's important that you do consider all the suite of tax issues, as I said, corporate tax, transfer pricing, and other operational tax issues in case of decommissioning or moving from SOR to SORA. With this, I would like to end my session. I hope you found the session useful. Please stay well. Thank you so much. And back to you, Philip.
Thank you. Thank you very much, Rajesh and Kwang, for your presentation. And I have to say that overall, I mean, despite the fact that we are all 2 hours in the WebEx today, we're only 6 minutes behind schedule, which is fantastically, which is a success compared to some other type of events. So thank you for the speakers to have managed to stay within their time, their allotted time. So we're moving now to the last panel of the day, which is the banking panel on legal and conduct. So we have it's an impressive panel here with Glenn Tho, Kok Chi Wai, and Francis Mock from Allen and Gledhill. We have Joyce Lai from DBS, Lin Lee and Po Mai Phuong from OCBC, Chan Moon Bin from Standard Chartered, and Ko Wee Kiao from UOB. And the panel will be moderated by Chikin Lam. Chikin, the floor is yours.
Thanks so much. Hi, I'm going to move very, very quickly through this. I'll do my best to keep us on time. Why do we have 8 lawyers on this panel? Because actually the legal and the conduct considerations map to each product segment, right? So derivatives, there's a bunch of issues. For bonds, there's a bunch of issues. For corporate loans, there's a bunch of issues. For consumer, there's a bunch of issues, and also conduct matters quite a bit. To kind of like structure the way we'll go through this, I do want to maybe put all the discussions into 3 buckets. And then I want to say that we will definitely move into Q&A to pick up as many of the considerations or concerns or questions of the audience as we can. Okay, so bucket number 1, one of the distinguishing points about Singapore is that we've put together a market compendium of legal protocols, legal documentation standards on a horizontal basis. We're not duplicating ISDA protocols, but what we're doing is we're laying that out together with bond protocols, with loan protocols, and with consumer protocols, so that basically professionals, in-house legal departments can basically take a look at the horizontal view. Okay, so bucket 1 is to brief on the existence of the market compendium and how this will evolve over time. Bucket 2, I think of primary interest to the attendees here today, will be basically how we're handling corporates. We've heard from very qualified speakers flagging issues in relation to mismatches, accounting, hedging, equal considerations around legal, and how we're trying to cushion the impact on borrowers of basically some of these adverse consequences that we don't want them to see. Okay, so bucket 2 is corporates. And bucket 3 is conduct. In conduct, we've basically got possibly customer engagement issues, considerations that financial institutions may have to take into account when they implement IBOR transition. Okay, so these are the three buckets we'll go through without further delay. What I'll do is hand over first to Ellen and Grethill on bucket 1. Ellen and Grethill helped us very much to do the market compendium, and so I'll hand over the time to GY.
Thank you very much, Jikit. And good afternoon to all participants. I'll spend the next few minutes on the SORA Market Compendium that was released in October last year. As Jikin said, the compendium is first and foremost a technical and to some extent a legal guide to the major products and primarily to give a more detailed information on the transition. The compendium sets out the background to the transition that's already been explained by earlier speakers, being the cessation of LIBOR, which affects the swap offering. And it explains why the SORA has been chosen as the preferred benchmark. The compendium delves into 4 major products, being loans, derivatives, capital markets, as well as consumer loans. And starting with loans, a typical bilateral or syndicated loan agreement will have its usual market disruption clause, which will typically default into the cost of funds mode. But of course, we all know that that is not desirable in the long term. And the recommendation as set out in the compendium is for fallback rate SOR to apply to legacy loans, and this is all set out in fairly great detail in the compendium. In the meantime, what has happened in the market is that for some loan documentation, we have what are called replacement of screen rate clauses or rate switch clauses, but I'm sure market participants will know that even if we use these clauses, we will still need to negotiate the operative provisions eventually. So moving forward, and as many speakers have already emphasized earlier, is the expectation that SORA loans will gradually predominate. And the compendium sets out the proposed language for SORA, whether it is look back with or look back without observational shift. And it explains the pros and cons of each approach, giving a worked example as well. So I think as earlier speakers have also reiterated, I think it's important for corporates and banks to start a conversation on the repapering exercise for legacy loans. For derivatives, the compendium talks about the present state of matter, which is that interest rate derivatives are pegged to SOR, and going forward, transactions should use SORA. And as Jikin has said, ISDA has done a fantastic job setting up the definitions, which now has a definition for SGD SORA compound. The steering committee has published template confirmations for the 4 common types of SORA swaps, and it describes where they can be downloaded for market participants to use. For legacy SOR transactions, the compendium explains that new fallbacks are needed because, just like loans, the previous ISDA fallbacks were not designed to handle a permanent cessation. So to this effect, ISDA has published 2 documents. First is the fallback supplement and fallbacks protocol, and the fallback used for SOR will be a fallback rate SOR. So first of all, taking the fallbacks supplement, this is meant for new transactions, and it amends the definitions of SOR and other IBOR rates to incorporate the new fallbacks. The fallbacks protocol, on the other hand, provides a mechanism for doing the same thing for the existing SOR derivatives. As with loans, the fallback SOR is an interim rate, and it will cease to be published sometime after the fallback trigger. So it is worth emphasizing that fallback rate SOR should not be used, if possible, for new transactions, and market participants should transition soon as possible to SORA. The same thing largely prevails for capital market instruments. The legacy floating rate SOR priced instruments may not have appropriate fallback mechanisms that deal with a permanent discontinuation of SOR. Typically, they may require bondholders' consents in order to move ahead in the future. So what the compendium has done is to set up the suggested fallback language for SOR instruments, which market participants should consider using and including in their present documentation. Moving forward, the SORA language, which is broadly similar to what one finds in loans and derivatives, is recommended, but there are some quirks in the capital market space due to different logistical requirements, and these are all set out in the compendium. For consumer loans, and this is the last category of products that the compendium touches on insofar as the transition to SORA is concerned. Just like the other products, SORA is intended to be the main interest rate benchmark moving forward. And the key emphasis here is on how banks should deal with consumers so as to assist the consumers to make informed financial decisions. This is just a very broad wrap up of the compendium. For those of you who have not had a chance to review it, take a look at it. It is available on the EBS website. And we'll be happy to take on any questions that the participants may have on the loans or derivatives and on capital markets in the Q&A session. Jikin, back to you.
Thanks so much. Okay, so we're going to move reasonably quickly through these three buckets of items, and then we'll go into Q&A, right? So up next will be Joyce. Joyce maps to the corporate loans subgroup as part of the SCSTS steering committee. So Joyce supports all the corporate loans work that's going on. Over to you, Joyce.
Hi, I hope everyone can hear me okay. Following on from Chiwai's quick run through on the market compendium, I did want to start by reminding everyone there are also two other reference guides that ABS has published together with SCSTS. One is the SORA corporate guide, which was written specifically in plain English to help summarize the issues that a corporate might face. There is an emphasis on loans and derivatives, but we do cover bonds there too. So that is helpful reference material for the people in the audience as well as your customers. The other useful thing is also an end user checklist, which was developed by PwC with ABS and SCSTS as well. Again, useful not just for banks and corporates, but for their customers. The user checklist is designed for smaller corporates with simple loan or derivative portfolios, as well as the bigger corporates that have a mix of SOR products. I won't sort of repeat some of the information that has been discussed already, but I did pick up a couple of interest areas from the questions that had been sent through so far. In relation to questions around syndicated loans and project finance loans, there is a consistent message, I think, from SG3 and SteerCo around early engagement, if at all possible, with the lending banks. We know that it usually is the agent that would start discussions between a syndicated group of banks or a club group of banks with borrowers. But if you are looking at a loan like that, that may have a very long tenor or is due to be refinanced shortly, then it isn't something you need to wait for the agent to come and approach you on. I think borrowers and lenders can still go and have conversations with the agents, potentially about formally kickstarting conversations about either making sure your loan will use fallback SOR, or you want to refinance into a SORA loan. And that early engagement is really important on the loan side as well as the swap side, because most of them will have hedges, and you want to maintain as close a match as you can between the two when you move either to SORA or to fallback SOR. There was some reference earlier to fallback SOR and shelf life. I think a lot of you may remember that there was an announcement around fallback SOR shelf life last year, which was 3 years from the end of 2021, the expected discontinuation date. I think we will hear confirmation, as Sing Xiong mentioned earlier, for formal guidance, but we do expect that the shelf life for fallback SOR will continue for that 3-year period. So there will be the ability for those who need to move on to fallback SOR, and then their loans may run out before fallback SOR expires itself. I want to make a quick point here on long dated loans. Now, we've heard about the possibility to use fallback SOR, but we also have heard about the encouragement for people who are ready and able to move directly to SORA. So one key thing to remember is you don't want to do two transitions for your loans. So have a careful think about when you want to transition and you're talking to your lenders, whether you want to go from SORA to fallback SOR, and then you're done because your loan will expire before fallback SOR disappears. Or if your loan extends beyond that shelf life, then you are leaving yourself open to the possibility of transitioning again to SORA, which you may not want to do. So do keep that in mind when you're having these discussions. Hence, we've repeatedly said, make it an early engagement as far as possible. I do want to mention one quick thing as well. We've been talking about compounded in arrears rates that fallback SOR will be and SORA would be. But I want to remind people as well that MAS has published SORA indexes and 1, 3, 6 months compounded SORA rates on their website, which is available for use. So there could be some loans and some borrowers and lenders out there who might want to look at referring to the SORA index or the 136 historical SORA compounded rates, which are publicly available on the website, and to have your loans refer to that instead. Now, that would mean that you are in a kind of compounded SORA, but in advance concept of using those historical rates or the index rates and then setting your rate for a forward-looking 3 or 6 month interest period. If you do that for your loan and some types of loans that will be appropriate, like trade finance loans, be aware then that you need to have a conversation as well with your hedge provider if you've got a hedge alongside it, because then you would need to look at your hedge accounting considerations, or whether you would need to look at bespoke hedging to try and match up with what you're doing on the loan side. In relation to ISDA protocol, we've heard mentioned that it is something that you can sign up to. The protocol is still open on the ISDA website. And it's an easy way to do multilateral arrangements with all your banks. If they have also adhered and you adhere to the protocol to amend your derivatives legacy. And forward-looking, you have these to supplement.
Did we lose Joyce?
Hi.
I think we lost you for a while, Joyce.
Yeah. Yeah, I was going to say for the ISDA protocol, please do look at signing up. Going forward, there's the ISDA supplement for your new trades. But one little point I want to make on the protocol in particular for amending your legacy swaps. You do need to have a quick look, talk to your advisors about the scope of that protocol. It covers particular swaps, but it doesn't cover all swaps. It covers particular benchmarks, but not all. And most importantly, for those of you who have syndicated loans and you would prefer a more hands-on approach to make sure your hedge matches your loan, you could sign up to the protocol to amend your legacy ISDA trades, but you are able to carve out trades that you don't want the protocol to apply to. And a hedge that goes with a loan or a bond might be exactly what you would want to carve out. But it does mean that the rest of your portfolio that is standard or vanilla can be easily amended. Otherwise, you are going to potentially be left with doing bilateral swap and loan amendments with every bank that you have out there. Now, one final question I see has come up was around adjustment spreads for derivatives and for loans. I think my colleague had answered the question online already. Fallback SOR was chosen originally to be the fallback to SOR, a safety net mechanism for us so that we don't end up in a situation where the contract doesn't know what to do with itself if SOR disappears. So fallback SOR was considered and decided to be more closely related to SOR because you still have your FX swap points, but instead of using dollar LIBOR, you are going to use adjusted SOFR, the replacement for US dollar LIBOR. So the idea was that fallback SOR is a closer relative to SOR, given the computation is familiar except for the US dollar LIBOR input. And so that was the direction that was chosen. When we then looked at the permanent replacement RFR benchmark, after consultation and studying, the SCSTS came to the conclusion that SORA going forward would be the permanent, more appropriate replacement rate. So that's why there's this dual track in Singapore that you perhaps don't see elsewhere, where there is this active encouragement and engagement from all of us to move our customers, if they're ready, as quickly as possible to SORA. But if for any reason that is not appropriate at this point in time or throughout the course of this year, then fallback SOR is always the default safety net that you can use, and you don't leave yourself exposed with a SOR loan come the end date of US dollar LIBOR or SOR coming through. Now, the adjustment spread for fallback SOR will take in the input of adjusted SOFR because, like I said, we're using adjusted SOFR instead of US dollar LIBOR. So we'll take up the adjustment spread set out in the calculation methodology by ISDA. And it does mean that your fallback SOR discussions around adjustment spreads may be easier because that is automatically taken in your calculation. For SORA, at the moment, the industry is considering adjustment spreads, and we are talking with SCSTS, ABS, and MAS on that. There is no specific guidance by the industry right now on whether there will be an adjustment spread for SORA for corporate loans. We do know that you will need the adjustment spread to pick up on the fact that SORA doesn't have a term element or a credit element the way the old rate does. And so for now, it is certainly something that we are aware of, and we are conscious that, you know, we need to keep considering whether we can provide some guidance around this. But the banks are looking at this as well and having bilateral discussions with their borrowers in relation to what particular adjustment spreads might be for people coming to them to talk about new SORA loans. We are aware, and SCSTS and MAS are very conscious in reminding the banks when we have discussions about SORA deals and what spreads we should be adding to that to make the SORA rate a little more equivalent to the previous rate, that we need to remember to abide by fair dealing principles and to be upfront and transparent with our customers, and to minimize as far as possible the economic impact that it could potentially have on the customer, the borrower, and the loan in question. So that's something that I think the banks are very conscious of, and we know that MAS and SteerCo, SCSTS will scrutinize us very closely around that. So there is hopefully some comfort to people while the banks are working through perhaps their individual adjustment spread methodologies and calculations. And I think I'll stop there.
Yeah, I was going to say we don't
we
didn't need 9 lawyers. We just need Joyce, and Joyce has answered every question and also answered the conduct one. but okay, thanks so much, Joyce, and thanks. That was awesome. It was really, really detailed. I think gave some insights as to how SCSTS was also thinking. I'll just leave a bit of room here for Lynn. Lynn, I think, that we may just want to do a little bit more detail around conduct, and then after that, we'll dive into the Q&A. Again, bearing in mind that, we've got to keep things on track in terms of timing.
Yes, I understand. Thank you, Chikin. Good afternoon, everyone. And thanks to Joyce for providing, a good summary and for bringing this segue into the conduct issues. So I think in the LIBOR SOR to SORA transition, many have actually focused on all the technical details, operational issues, but it's also time that we be vigilant about what we call conduct risk, right? And addressing all the customers' requirements in the benchmark transition process, because customers are actually at the heart of what we do. So a brief outline of what I'll be sharing in the next 5 to 6 minutes, what conduct risk is, and Joyce has actually answered that, is about fair dealing, and what can be done to mitigate conduct risk and applying that in the Singapore context. So what is conduct risk? So it's about, like what Joyce said, fair dealing. So I only just want to highlight one point, that in the Singapore context, as mentioned by our keynote speaker, Mr. Leong Sing Cheong this morning, MES is actually urging banks to proactively engage customers to transition out of your SOR legacy contracts during the second half of 2021 when the SOR and SORA rates are still liquid. So there's a little bit of timing urgency on this because SOR liquidity will actually dwindle in due course. So moving on what we can do to mitigate some of this conduct risk. So in the interest of time, I'm just sharing 2 key approaches. Number one, which Joyce has also alluded to, customer engagement. So early customer engagement. And of course, very importantly, the second point, giving customers adequate options. So on the customer engagement issues, banks need to help customers actually understand some of the critical issues. For example, the expected discontinuation of the LIBOR and SOR. What are the implications on the existing contracts? Are there robust fallback provisions in place already? Are there swaps that are tied to the loans? Are there hedge accounting issues, tax issues? What are the alternative benchmarks that you can transition to? How do you compute the risk-free rate benchmarks? What are the established market conventions? Or are there even other options for clients? I can imagine some of the smaller corporates and the consumers, they may be open to fixed rate packages as well, given that there is certainty of cash flows in fixed rate packages. But the purpose of all this early customer engagement is to ensure that, when banks and customers decide on the replacement benchmark rates, banks will need to ensure that the replacement benchmark rate is fair, and customers will also need to perceive it as fair. So that will help to address some of the conduct issues. If fallback language is actually being inserted into your legacy LIBOR SOR contracts, there should also be clear communication to customers how these fallback provisions actually work. When are the fallback rates triggered? How do you compute the fallback rates? And we also want to highlight customer conduct risk can also arise if customers feel that they are being forced to change a rate without adequate options, which is why it's critical that banks have a full suite of SORA products available for customers, and ABS and SCSTS has issued guidance on that, right? By end of April 2021, all banks to have available a full suite of SORA-based products for customers. In the Singapore landscape, moving on to the Singapore landscape, I am actually very grateful for the leadership that has been exercised in this SOR to SORA transition. I think SCSTS was established sometime in late 2019 to oversee the SOR to SORA benchmark transition. The mandate has been expanded recently in December 2020 to include the SIBOR to SORA transition as well. And there have been a lot of market guidance issued by ABS, SCSTS in the benchmark transition process. And the ABS website, if you have not taken a look at it, I encourage you to do so. It's a very, very useful resource. In terms of raising public awareness in Singapore on the transition issues, ABS have organized multiple webinars. So including this webinar that is done in partnership with ASIFMA. So really want to thank ASIFMA and ABS on organizing this webinar to raise awareness. And as mentioned earlier by our keynote speaker, SCSTS and ABS will launch a media campaign to raise a public awareness of the SOR to SORA transition and to encourage the bulk of the retail customers to transition to SORA loans. We also understand there will be a revised transition roadmap for 2021 to guide active transition of the existing legacy SOR contracts and to promote more uptake of the SORA cash products. On the IBA consult results, I saw a lot of questions about that. We think that the IBA consultation results will be released sometime in Q1, early Q2. After that, SCSTS will likely develop a customer engagement letter to highlight to affected customers of existing SOR loans about the expected discontinuation of SOR, probably sometime by end June 2023. And the purpose of this customer engagement letter is to encourage, affected customer to think about, refinancing to SORA packages. And in my personal view, it may be a good time to think about repricing some of the legacy SOR loans, given the low interest rate environment that we are currently in. And of course, the industry is also very concerned about a large tail of customers who may not take active steps to transition out of the SOR loans. So we are debating at the industry level on how to deal with this portfolio of legacy SOR loans. Proposals are currently being worked through with the relevant agencies, including MES, CASE, FEDRAC, and the Competition Commission. And SCSTS will probably communicate further updates in due course. I think that's all on my side. So thank you, Chikin. I want to pass the time back to you.
Okay, that's awesome, Lynn. No doubt there'll be questions. I think maybe one of the overarching things is that I think really with MES, with the steering committee, we're all fundamentally committed to basically ensuring that this transition is smooth. It's done in the interest of the industry as a whole. It's not done to favor any particular segment, and it really produces an orderly and smooth transition for something that was really kind of created outside of our jurisdiction, but now we have to work through the consequences within our jurisdiction. That's the kind of like the way we're approaching all this. I think let's dive straight into some of the questions that have been answered. And if anyone feel free to jump in. I'm just going to read out some of these answers. What derivative fallback would be appropriate if counterparties don't agree to exclusions from the ISDA protocols? So they don't follow the ISDA protocols. What fallbacks would be available for this? I think this one is either Manbin?
Hey, hi, thanks, Chikin. I think the problem with the existing fallback in the existing ISDA 2006 definitions is that if there's no rate available, right, you have to do a polling of 4 banks in the market, and for SOR there is a formula which you have to fill in the LIBOR rates and FX rates and so forth. So if parties do not want to include the fallback under the ISDA protocol and supplement, then I think I'm not sure whether there are any other options realistically, given that if you do polling when LIBOR ceases, there are likely to be no rates. No banks may want to quote their rate because LIBOR has already ceased. So I think personally it would be advisable to apply the fallback rate. The fallback rate is applied or selected after extensive consultation. This is also the fallback rate which LCH will apply as well. Thanks.
Thanks so much, Manbin. Pick up one more. Let's see. Actually, there was a question in the chat which people don't have the benefit of reading here. One of the questions was that, is there going to be standard adjustment spreads? We've answered that already. Will MES get a bit more interventionist and release regulatory expectations on conduct? I think that can be answered by MES, but in some ways, I would expect that we don't wait for MES only to think about conduct. I think we can work through a lot of the implications that Lynn has outlined already. But yes, do expect MES to say, something around expectations on conduct. Okay, one more question here. Can market players toggle or switch between IBOR and risk-free rates? This one, I think anybody can take. Joyce or Manbin, I think. Can market players toggle or switch between IBORs and risk-free rates?
I can try and take that for the loan side and derivatives as well. There is a mechanism that actually I think Chiwai mentioned earlier, which is a switch mechanism that LMA has published provisions for. And we are aware that people in the market are looking at a switch mechanism. That is one that allows you in your loan to switch from your current LIBOR or SOR rate into your RFR rate. I do think that it is designed to be a one-time switch and not for people to toggle back and forth between the old LIBOR rate or SOR rate and the new one. That may give flexibility, and it may give the opportunity for borrowers to look at what the current rates are and then move from one to another. But I do think there will be operational and admin considerations to think about, at least on the loan side. If you keep switching back and forth, the banks as well as the borrowers may find that difficult to do in calculating your interest payments and accruals. And it may be operationally quite a clunky thing to do, even though there may be advantages in doing that. I think on the derivative side, if you sign up to the protocol, you're in, unless you carve up particular trades. The fallbacks will kick in when the triggers come in, and the RFRs or the fallback rates set out in the protocol will apply. And it will be the same for the ISDA supplement for new trades being struck. So again, if you follow those particular mechanisms, I don't believe there will be an option for you to switch back and forth. It is something that I expect you can approach your banks to talk about if it is something so critical to your loan or your swap. But it is likely then that you're talking about a bespoke loan or a bespoke swap, which then not just may mean particular adjustments on systems and calculations on both sides, but there could be some increased costs because you are asking for an unusual set of terms for your loans and your hedge. Hand over to Manbin if you have anything to supplement.
No, nothing much for me to add. Agree. There's no on the derivative side, when the fallback kicks in, it kicks in. There's no toggling back to the LIBOR. I mean, the reason why it kicks in is because LIBOR has either ceased or has become non-rep. So it doesn't provide for a toggle back.
And I think practically what we can expect also, right, is that liquidity in the IBORs is going to fall, and liquidities in the RFRs is going to rise, right? So I think Sing Chong said this earlier. We're going to hit this sweet spot in the market when kind of like both are of a reasonable level that we can do the switches quickly, which I hope will also answer this question in there about compression and conversion cycles. I hope we understand the difference between the two. Compression is basically the parties agree to stop those trades, and conversion is that the parties agree to switch those trades from whatever the legacy rate is to the new rate. And this will basically be a moderated, structured cycle that SG1 is going to talk a bit more about as they guide the market as to what to do. I'm very, very mindful of time. Philippe, I would propose that we just race through one or two more questions and then we hand the time over back to you. Is that okay?
Yeah, that works for me.
Okay, so I think there's one more question that I think is material here, which is there any government-linked governance body established to handle client conduct-related complaints? Actually, the rule generally is FIDREC, is actually the Financial Industry Dispute Resolution Mechanism. And this applies primarily to consumer-related complaints, and that is the government-linked body. However, nothing stops basically MAS from taking a consumer enforcement type of a role. Nothing stops the Competition Commission of Singapore to take an enforcement type of role. And also we've got consumer advocate bodies like CASE. So Lynn covered these things. And so what we're trying to do as an industry also is to make sure that all these bodies who may have an interest in the conduct related aspects of what we're doing, we engage all of them really early, arrive at an industry aligned position. So, you know, nobody can object later on. And then we implement the industry aligned position. That's one of the things that we can achieve as being in Singapore. And I think that answers all the questions except for one really detailed one. I think we've got to pause on that one. That will take too long. Okay, so I think we're really done. Any other colleagues want to say anything? Ellen, Hill, Hui Kiao, my phone. Otherwise, I think we're good. We're good. Over back to you, Philippe. Thanks for having us and thanks for letting us race through a ton of content.
No, thank you very much, Ying, and thank you very much all for your participation to this to the panel. Very insightful. Thank you very much for that. So I would like to we coming to an end now, close to an end to the to this webinar, and I would like to welcome Vernice Mo. She's the managing director of ASEAN for Refinitiv, our lead sponsor, to provide some closing remark. Vernice, floor is yours.
Thank you, Philip. Can you hear me?
Yes, we do.
Thank you. So good afternoon, everyone. I don't understand in between lunch and me. So thank you, ASIFMA and co-host the Association of Banks in Singapore, ABS, for getting the industry together virtually for this event. Very well attended event. I'm really quite impressed. So I'll just like to take this opportunity to share with the audience here the news that you will have heard the last few days. I'm pleased to announce that as of last Friday, the London Stock Exchange completed its deal to buy Refinitiv. So we are now part of London Stock Exchange Group. In short, we call it LSEG. So as a combined organization, we will continue to support you across the markets and communities that we serve. We know that our members, our customers expect us to be reliable and resilient, and we greatly value the trust that you place in us. So as a leading data analytics provider, as well as a benchmark administrator, Refinitiv has a key role to play in this global initiative and are honored to be part of ASIFMA's effort in Singapore as well as the region. So in terms of ASEAN journey in preparing for the transition, our observation is that, and I will agree with a lot of the speakers here, that several local benchmarks and financial products in this region are still very heavily reliant on LIBOR. And within ASEAN, we have also seen different levels of readiness from one market to another. So as small markets phase out their local IBORs and replace them with risk-free rates, we begin to see local risk-free terms rate emerging, as my colleague David Ricker has suggested. So here at Refinitiv, we have been actively discussing such initiatives with Central Bank and Association. In Singapore, we have seen a lot of work done to prepare market participants, such as key initiatives delivered by MAS that supports the adoption of SORA. So with the foundation in place, it does make an easier transition. So for instance, MAS has done a great job in establishing clear and common protocols around key areas such as fallbacks and compounding methodology, as I think Lin Lee has alluded to as well. So this has actually allowed Singapore interest rate market participants to manage SOR exposure and make great progress in moving to SORA for issuance of new derivatives, bonds, loans, just as we have seen some of the banks here already launching SORA-linked product well. So now it's really up to the market participants, yourself, who must then deploy the new pricing protocol and processes into your internal systems. The faster you do it, the smoother the transition will be. So how can Refinitiv support the community here? We have actually seen a lot of questions from tier 2 and tier 3 institutions globally. And the common challenge that they have mentioned to us is data. So just as many factors that will contribute to the success of IBOR transition, which Andrew from DBS has mentioned earlier, the reliability and access to data are also very critical to this transition. Ultimately, it will help reduce your operational risk and potentially increase the attractiveness of the Singapore market. So here, what we'll do is we'll continue to provide clients with more information in a very consultative manner, data sets, developing new and also enhancing our existing products and tools across our offerings to help you with the transition. So in closing, we know that the transition will have its hurdle, but we at Refinitiv will work together with you to minimize the disruption and maximize the efficiency. So with the Lunar New Year around the corner, let me wish everyone here in advance, 恭喜发财, an abundance of wealth, health, good prosperity, and a peaceful IBOR transition. Thank you, and Philip, over to you.
Thank you. Thank you very much, Vernis, for these closing remarks. And so we're coming now to the end of this webinar. Let me again thank all the participants for having joined us. First of all, also I would like to thank the ABS for partnering with us in co-hosting the event, our lead sponsor Refinitiv, and our gold sponsor ENY for your strong support to the event. As I mentioned, most of the webinar is recorded and will be shared on our website very soon, together with the slides of all the various presentations. So again, thank you very much. Would like to also to thank the events team here, Flora and Millie, who's behind the scene, have done a fantastic job to making this success. So thank you all, and I wish you a very good afternoon, and hope to see you very soon, virtually or in person. Bye-bye.
Thank you, Philip, and thank you everyone for being with us today. As Philip said, we'll be sending you an email within the next couple of days, which contains the link to view the recording of today's session. Please feel free to share it with your contacts. And our next event will be on the 25th of February on managing regulation-driven market fragmentation. And we are very excited to have a great lineup of speakers as shown on the screen. If you wish to register for this event, please go to ASIFMA's website and go under the event session to register. Have a good day, and we hope to see you at our next session. Thank you.